Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 1, we covered some top preferred stock ETFs for steady income and low risk. Now in Part 2, we'll look at a few more ETFs and share what to watch for before you invest. Let's get into it. Credit risk and issuer defaults. Unlike treasury bonds, preferred shares depend on the issuer's financial health. If a company struggles, dividends stop, and recovery in bankruptcy is murky. Watch for heavy exposure to shaky sectors, e.g., regional banks in 20-3. Low-rated issuers. Some ETFs screen for quality, like FPE, others don't. Tip: check the ETF's top holdings. Diversified funds spread risk better than niche ones. Limited growth potential compared to common stocks. Preferred ETFs excel at income, not growth. Their share prices rarely surge like common stocks, and callable features can cap gains. For example, if rates fall, issuers often redeem high-yielding shares, forcing you into lower-paying replacements. Dividends stay flat, no raises like growing common stocks. Think Apple or Amazon. Tip: balance preferred ETFs with common stocks or growth ETFs to cover both income and appreciation needs. Play the long game. These risks matter less if you hold for years, reinvest dividends, and stay diversified. Top preferred stock ETFs to consider. Not all preferred stock ETFs are the same. Some focus on broad markets, while others target niche sectors. Below are 3 of the most popular funds, each with distinct strengths for different investing goals. A-Shares Preferred and Income Securities ETF, PFF. PFF is the largest preferred stock ETF with over $12 billion in assets. It tracks the ICE exchange-listed Preferred and Hybrid Securities Index, holding more than 450 preferred shares from financials, utilities, and REITs. Expense ratio, 0.46%. Dividend yield, around 6%, varies with market conditions. Key feature: broad diversification, making it a solid core holding for income seekers. PFF leans heavily toward financial firms, about 80% of holdings, which can be a pro or con depending on your outlook for banks. Its high liquidity means you can trade easily with tight bid-ask spreads. Invesco Preferred ETF, PGX. PGX takes a slightly different approach, focusing on higher quality preferred shares. It tracks the ICE BUF AML Core Plus Fixed Rate Preferred Securities Index, which screens for investment-grade issuers. Expense ratio, 0.50%. Dividend yield, roughly 5.5 to 6%. Key feature: emphasis on financially stable companies, reducing default risk. PGX's portfolio includes a mix of financials, energy, and healthcare stocks. It's a good pick if you want steady income with less credit risk, though the higher expense ratio eats slightly into returns. SPDR ICE Preferred Securities ETF, PSK. PSK stands out for its actively managed approach, allowing flexibility in selecting preferred securities. Unlike passive ETFs, it can adjust holdings based on market conditions. Expense ratio, 0.45%. Dividend yield, typically 5 to 6%. Key feature: active management helps navigate interest rate shifts and credit risks. PSK holds around 200 preferred shares, with a heavier tilt toward utilities and insurance firms. The active strategy comes at a slight cost premium, but it may be worth it for those wary of rate hikes. These 3 ETFs cover the spectrum: broad exposure, PFF, higher credit quality, PGX, and active management, PSK. Your choice depends on whether you prioritize yield, safety, or adaptability. How to invest in preferred stock ETFs. Adding preferred stock ETFs to your portfolio isn't complicated, but doing it well requires a plan. Whether you're after income, stability, or diversification, how you allocate and manage these funds makes all the difference. Let's break down the key steps. Portfolio allocation strategies. Preferred stock ETFs work best as a supporting player, not the star of your portfolio. Here's how to fit them in. Income bucket. Allocate 10 to 20% of your income-focused holdings to preferred ETFs. Pair them with bonds and dividend stocks for balanced cash flow. Diversification move. Use them to reduce volatility if you're heavy in common stocks. For example, swap 5 to 10% of your equity allocation into preferred ETFs to soften market swings. Sector-specific plays. Some ETFs focus on sectors like financials or utilities. Overweight these if you're bullish on the industry, but keep exposure below 5% of your total portfolio to avoid concentration risk. Rebalance annually. If your preferred ETF allocation drifts too high from price gains, trim it back to your target percentage. Evaluating performance and fees. Not all preferred ETFs deliver the same value. Look beyond the yield when choosing a fund. Compare expense ratios. Fees over 0.50% eat into returns. Stick with funds like PFF 0.46% or PSK 0.45% for cost efficiency. Check historical performance. See how the ETF handled rate hikes or downturns. A fund that dropped less during the 2018 or 2020 sell-offs likely has better risk management. Dividend sustainability. Review the fund's payout coverage ratio. If dividends are consistently covered by issuer payments, the yield is safer. Morningstar or ETF.com screens can help compare these metrics side by side. Timing the market versus long-term holding. Preferred ETFs aren't for short-term bets. Here's why. Interest rate cycles. Trying to predict rate moves is risky. Instead, drip-feed investments over months to average into positions. Call risk. If you buy during high-rate periods, you might lock in attractive yields until the shares get called away later. Long-term compounding. Reinvesting dividends for 5+ years smooths out price fluctuations and boosts total returns. If you're unsure, start small. Invest a set amount monthly to avoid overexposure at a single price point. Preferred ETFs thrive with patience. Tweak allocations as needed, but let the dividends do the heavy lifting. Preferred stock ETFs deliver higher yields than bonds with less drama than common stocks. They shine for income-focused investors who value steady dividends and lower volatility. But they're not bulletproof. Interest rate swings and callable features can dent returns. The best approach. Blend them into a diversified portfolio. Pair them with growth stocks and short-term bonds to balance risk and reward. Funds like PFF, PGX, or PSK offer different advantages, so pick one that aligns with your goals. Ready to explore further? Talk to a financial advisor or dig deeper into fund specifics before jumping in. Even small allocations can make a difference in smoothing out your investment journey. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.